For this week's Smith Business Close-Up, we're on location at the University of Maryland, and joining us is David Kass, an Associate Professor of Finance at the Robert H. Smith School of Business. Dr. Kass, thank you for being with us.
Thanks for having me.
We want to talk about the stock market, and it's something that you got involved in just a few years ago when you were 12 years old.
That's right, just a few. At that time, my grandfather gave me 5 shares of a $20 stock. It was actually called Long Island Lighting. I was growing up in New York City. It was a local electric utility. And from that day on, I became pretty much hooked on the stock market, reading about economics, finance, what it was that made stock prices go up or down, and what affected my investment. The $100 gift that I was given seemed like all the money in the world for me at the time, so I had to watch it carefully, and I did. And it developed into my basically career.
So it paid some dividends. What?
Yes, very high rate of return on that investment.
What became of the stock?
The stock itself I held for many years, and then in actually the fall of 1973, I was then actually a student in graduate school at the time. There was several economic shocks, oil shocks in the economy, a couple of oil war in the Middle East, and the few positions that I owned at that time I sold, and that included Long Island Lighting.
So this is a great way to illustrate some of the challenges for individual investors in dealing with fluctuations in the stock market. What have you learned along the way?
Well, basically the goal, the ideal, is to have a long-term target, planning to hold stocks for 5 years, 10 years, 20 years or longer, and not be bothered by major swings. Stocks do fluctuate rather rapidly, and largely can go up or down 30% in a given year, but sometimes there are major economic events that might cause one to change that philosophy and not hold on. An example, besides 1973, certainly the financial crisis that we recently had, 2008, 2009, and between the fall of 2007 and the spring of 2009, the Dow Jones Industrial Average dropped 55%, and it's pretty hard to hold on under those circumstances. So even though it's desirable to hold on, the markets do come back, but while the market is falling, what do? Do you hold on knowing that tomorrow, or believing that tomorrow it will be worth less than it is today? It's a very difficult psychological problem to overcome.
For individual investors, individual Americans, who do you think ought to be involved in stocks, and in what way?
Yes, I think anyone certainly planning for their future, savings for your retirement or for a child's education, that stocks should be a major component of your savings. The rate of return from stocks, going back 2 centuries, various studies have been shown that the rates of return are approaching 10% a year on average. And if you compare that to fixed income, such as bonds, government bonds, they are substantially lower. So over the long term, you will certainly earn a higher rate of return. However, each person has their own degree of risk tolerance. And for some people, it may make sense to put 60, 70% of their savings in the stock market. And for others, it could be close to zero, 10, 20, 30%, because the fluctuations in the market would bother them a lot along the way.
Plenty of alternatives for how to invest, different companies, different types of funds or individual securities. How do you see that?
Well, what I would recommend for the public in general, with respect to whatever asset allocation you decide to put into stocks, such as 50% of your savings, I recommend a Standard & Poor's 500 index fund. It's a low-cost fund. There are families of funds such as Vanguard and Fidelity that offer these funds, something you could put away and pretty much track the market. And in fact, index funds over time, over 1, 3, 5, 10 years, outperform the vast majority of actively managed mutual funds. So I would certainly recommend that. And if the individual would like to purchase individual stocks as well, certainly one company that I've followed for many years is Berkshire Hathaway. Warren Buffett being a hero of mine. He does have a Class B share, currently selling for about $137 a share. One does not need to buy 100 shares or a round lot. One could buy an odd lot, and I think that would be one particularly good investment. And there are other such individual stocks that are quite good and safe, relatively safe.
Very good. David Kass of the Robert H. Smith School of Business, thank you for being with us.
Well, thank you again. Thank you.